So, why should you consider investing in companies that pay dividends? Dividends and dividend growth are a sure sign that a company is doing well and generating earnings. Since we know that dividends are payments made from a company's earned profits, they're often undisputable proof to you, the investor, that the company is performing strongly enough to earn a regular profit and that it's experiencing enough positive growth to allow its dividends to increase. As an investor, you don't want to gamble and take chances with the stocks you buy, and you certainly don't want to just buy shares in the hopes that you'll get lucky. Dividends offer a real-life indicator of the health of a given company, one that cannot be faked or exaggerated. If dividends are regular and growing, they're a true sign that the company is mature and stable enough to support a healthy level of earnings. But surely the company's earnings report offers all the information you need to determine how well that company is doing, right? Not necessarily. Earnings reports can be easily skewed to make a company's current situation look better than it actually is. Because of the effect it will have on their stock prices, there's a big incentive for companies to meet their earnings objectives, or at least to appear as though they have. And by simply using some creative accounting techniques, such as treating the sale of assets as earned income or spreading out debts over a longer period of time, snapshots of company earnings can be made to appear more positive than they actually are. So make sure that you don't believe in everything shown on your company's financial statements. On the other hand, dividends don't lie. They'll always tell us the truth. There's no creative accounting when it comes to dividends, because a company either has the money to pay them or it doesn't. The old saying, "Don't believe everything you read," holds true for investors as much as anyone else. Dividends are not just figures you read in a report. They're actual cash payments given to you, the investor. And as such, they are one of the best ways to determine the true state of a company's finances. Furthermore, when dividends are not only paid regularly, but are increasing in value, they are a signal to the investor that a company is in a state of growth. A positive dividend status will have a positive effect on a company's stock price. At the same time, because companies understand that decreasing or eliminating their dividends will have an extremely negative effect on their stock price, that's the last thing a business would voluntarily do. Therefore, you can be certain that if a company's dividends are regular and growing, or are decreasing or being eliminated, these factors offer an accurate and unbiased statement about that company's financial position. Remember, as an investor, it's crucial that you consider a company's dividends. In the stock promotion game of show and tell, there's always a certain amount of flexibility in what a company can tell you about its earnings. But when it comes to showing you, dividends always speak the truth. Therefore, by considering companies that have been paying good dividends to their shareholders, you can avoid yourself from making bad investment decisions, thereby increasing your chance of making a profit from the stock market. In the next lecture, I'll talk about the compound effect and how taking advantage of the compound interest can help grow your money much faster and generate more and more passive income from your investments.